All right, let's get started. We're going to start off in this video by digging down deep into a balance sheet and spending a little bit more time talking about some of the complexities that you might observe in a farm balance sheet. So this is a balance sheet that I pulled from a textbook. So I'm citing my source here, which is the appropriate thing to do when you use someone else's content. This is from Financial Management in Agriculture, 7th edition by Peter Berry and Paul Ellinger. And this is an example of a complicated balance sheet for a farm. So it has some more complicated elements in it that I wanted to show you. In addition to showing you that, I'm going to show you some basic calculations in Microsoft Excel that you're going to need to use whenever you're building your own balance sheet. So the first thing I want to kind of show you is the way they've got their assets broken down. And I'm going to focus on assets in this first video. I'm going to make another video for the liabilities and the equity. The first thing is we have 2 years. So this is what you would call a comparative balance sheet. This is a balance sheet that looks at change over time. So this is the last day of the year in 2009 versus the last day of the year in 2010. And the goal here is to simply see how the snapshot of the business has changed during that time period. And we're going to walk through some of these things that have happened and talk about some of these items. We always break things down by current assets and non-current assets. Some balance sheets will break things down by current, intermediate, and long-term assets. You just have to kind of learn to read these things and adapt as you read them. So in the beginning, the farm had some cash. And that amount of cash grew over time. They had some short-term deposits. This is like a savings account at a bank or something like that. And that again has grown over time. So we have two different cash accounts at a bank account. And remember, no one's actually got cash on hand in any meaningful amount. What we mean is money in a checking account. And as I'm recording this, that's a strange concept to most young people who don't write checks for things. But accounting is kind of slow to adapt the terminology to new things. So cash is money that you can get your hands on really quick. This savings is also money you can get your hands on really quick. Now the next item is marketable securities. And I want to point out the wording here, marketable securities at market. So there's a phrase called mark to market. And what that means is that when you're trying to find out the value of an asset, you check the market value of that asset and you assign the current market value to the value of your asset. And that's kind of a complicated thing. What's going on here is that this farm in 2010 is holding on to some contracts sitting at the Chicago Board of Trade, meaning they've bought or sold contracts that represent their crops up in Chicago. And this is something that's very commonly done in order to hedge. And what's going on here is that the farm has lost $72,350 in 2010 on their marketable securities. And that seems like a bad thing to begin with. But if the farm is hedging, this is okay. This is the intention. You're going to make that money up on your physical crop that you have located on your property. Even though you've lost money in Chicago, and things will change. You'll start making money there, vice versa. We could teach an entire class just on this topic, and there will probably be some videos coming up one day on this topic as well. So I just kind of wanted to point that out. Next item, accounts receivable. This is where the farmer has sold something to somebody, and the person has not paid the farmer yet. And because the farmer intends to get paid during this accounting cycle, we list it as a current asset. This is a common thing in agriculture. It's not unusual for a farmer to sell a crop or some portion of the crop and then not get paid the day they sell the crop. Now we're going to move down to inventories. And the first thing I want to point out is there's a little bit of language here that you might not recognize. SCH1, that stands for Schedule 1. And what this is telling us is that there is another document that's part of the overall financial documents for this farm that's breaking down the inventories. It's going to show how inventories have changed over time. And again, this isn't physical inventory of how your livestock, crops, and feed have changed over time. This is a financial inventory. So this is how the value of these items have changed over time. And then we're going to break down these inventory items into livestock, crops, feed, and then some other supplies. So these again are things that you're going to be doing to make money, right? You're not necessarily selling those supplies, but you're going to use those supplies in order to grow the crops and the livestock so that you can sell them. One thing I want to point out here, the $72,350 marketable securities seems to be entirely offset by the $72,350 worth of livestock in 2010. Another item is cash investment in growing crops. So what's going on here is this is a balance sheet in December, and unless you're planting winter wheat, you probably don't have any crops growing in December. If our fiscal year ended in the middle of the summer, we might have a line right here. So this is the money that was spent in order to plant and produce a crop that's growing, and we have to have an accounting of that. So if you have a crop that's actively growing in the field, you need a line for the cash investment in the growing crops, because that is an asset. That crop that is growing is an asset. The next item here is prepaid expenses on Schedule 2. It's not uncommon for farmers to go ahead and prepay expenses for the next. This is oftentimes done as a way to kind of smooth out the tax burden. So if you've had a profitable year this year, you might want to go ahead and buy your seed and pay for the seed this year, and that will lower your income tax bill this year. So it's not at all unusual for a farm to go ahead and buy some feed, seed, fertilizer in the tail end of the current year, and then they're going to use that stuff at some point during the next year. So that's our prepaid expenses. Next, we have some other categories for current assets on the farm and personal, and this is one of those things that gets really tricky when we talk about farm finance. It's not unusual for farm finance and the farm household finance to get intermingled with each other. Most farms are not just businesses, they're also household units, and so it's not unusual for our farm accounting to have personal assets listed on the farm balance sheet. Now we have a total for our total current assets. In order to total that, we're going to use the auto sum feature in Microsoft Excel. This is a way to quickly get our hands on functions in Excel to add things up. So we're just going to find the sigma in the upper right hand corner and click on it. And it's going to go ahead and attempt to guess what we want to sum up. We want to sum up the entire column. So we're going to click and drag to make a small adjustment and release and hit enter. And now we have summed all of the total current assets for 2009. Then we're going to do a Control C to copy and a Control V to paste to get a sum for all of the 2010 items. And we see that we have fewer current assets in 2010, which may or may not be a good thing. Let's take a look at our non-current assets. First item is breeding livestock at market, and that can be found on Schedule 3. Then we have machinery and equipment, again at market, that you can find on Schedule 4. Investments in capital leased assets, investments in cooperatives. So this is a thing that you oftentimes see on a farm balance sheet. A lot of farms own stock in cooperatives, meaning they are members of cooperatives. I have some videos on cooperatives. I'll see if I can put one of those fancy YouTube links up here somewhere if you just want to go watch a video on cooperatives and kind of learn how they work. Other items on this list, such as the breeding livestock and the machinery, are things that can be depreciated. So these are any assets that you're going to use over multiple accounting cycles, and there's probably going to be a depreciation schedule for these, or some type of schedule to show what the value of these things are at the market, which it seems to be how they've done the accounting here. Investment, other entities, retirement accounts. Again, we sometimes see the farm assets and the household assets commingled, and so the retirement accounts are listed as a non-current asset on this particular balance sheet. Cash value life insurance. It's not unusual for businesses to take out cash value life insurance policies on the main operator of the business or the CEO of the business. That way, if they pass away, there's an insurance payout in order to cover the financial liabilities of the business. I'm going to have to probably make another video that I'll try to link to, ranting on why you shouldn't be buying cash value life insurance. And that is something that's hotly debated. Mostly the people who sell cash value life insurance think it's a good idea, and every other financial advisor on the planet says that it's not. But it's not an uncommon business practice to see a cash value life insurance here listed as an asset. Not the way I would do it if I were running the business, but hey, I'm not running this business, so that's fine. Now we have some long-term financial assets and non-marketable securities that is blank in this category. Farm real estate, broken into the land and broken down into the buildings. Farm land tends to go up in value. It tends to appreciate. Buildings and improvements tend to depreciate. They tend to go down in value. And once again, we have the possibility for farm and personal assets on the balance sheet. Now we're going to total all those up using the auto sum. And once again, Excel tries to guess what we're trying to do and has guessed wrong. So we're just going to drag up to get the correct area summed. Hit enter and we get just over $800,000 in current assets. Why don't we copy and paste that formula so that we now have a total for both years. Now we have to total up all of our assets. So we're just going to hit an equal sign and then click on our total non-current assets of $808,000 and some change, type a plus, and click on our total for current assets and hit enter. And that gives us a total assets of just over 1 million in this accounting cycle. And in the following year, Control C to copy, Control V to paste, we get slightly over $1 million in total assets. Total assets for this operation seems to have declined, which may or may not be a good thing, but that's a discussion for another day. What I'd like to do now is go ahead and hit pause on this video and put a break in it and make another video for the rest of this balance sheet, because this video is getting a little bit on the long side. So stay tuned for the next video, and thank you for watching.